Welcome back to our segment we call You and Your Money, and we're always joined by Jim Griffith of Griffith Financial. How you doing there, Jim?
I'm doing great, Rob. How are you?
Great? I don't know, a little tough with the football season. I'm kind of trying to see if I can get it together, Jim.
Man, it's going to be all right, Rob. It'll be all right.
Well, Jim, today we're going to talk about the 401ks and IRAs and how do you roll those over. When you look at IRAs and 401ks, how and when do you move 401 to IRA?
Yeah, it's really important now to be careful because there were some rule changes by the IRS in 2015. One way to move money is to do a simple rollover. The other way is to do a custodian to custodian transfer. You can also liquidate that account 100% if you're over 59 and a half, pay the taxes and walk with the money. If you're under 59 and a half, you have to pay that 10% penalty and the taxes. And you can also move it from one 401k plan to another 401k plan if the new company allows it.
Now, how does a rollover work?
A rollover simply is when you have the money sent from the current financial institution to you, and that check is cut with your name on it. Now, that becomes a little problematic sometimes because there's a 60-day rollover rule. If you have that check sent to you, you have 60 days to actually put that money into another qualified account. If you don't, you're assessed a 10% penalty if you're under 59 and a half, and you still have to pay the taxes on that income. What we recommend to do is to have that check cut. If you're going to do a rollover, don't put your name, instruct the institution to not put your name on the check, but to put the new institution's name on the check, and then make sure you deposit that check within 60 days.
Okay. Now, when you talk about trustee and custodian transfer, how does all of that work?
Right. The difference is simply this. On a rollover, the check is sent to you in your name. A trustee to trustee or custodian to custodian transfer is the money never is sent to you, it never touches your hands. It's simply sent from the custodian or trustee from the old financial institution to the new financial institution. That way, you don't have to worry about the IRS problems, and you can do as many of those a year as you want to without any tax implications. It's just on that rollover. Just remember the distinction is with the rollover, they're actually sending the money to you. With the custodian to custodian transfer, the money never touches your hands. It goes from one institution to the other.
And see, therein lies the problem with that. If they send the money to me, it'll never get to where it's supposed to go. But anyway,
and that's one of the reasons for the change in that rollover rule.
Right.
A lot of people were, we're in a mobile workforce now. A lot of people have several different 401ks. They kind of leave them at the old company. So when they need some money, as I said before, when people need money, they'll find a way to get to it. So that's why we have that rule in place.
Absolutely. Now, what are the major things to be concerned about when rolling over retirement account funds?
Well, let's just take a look at what the Internal Revenue Service says about this.
Okay.
Hi, I'm Cecilia, and I work for the Internal Revenue Service. Did you know that you can move funds from your individual retirement arrangement and retirement plan to another IRA or plan? There are two ways. You can have the funds directly transferred from one account to another IRA account or plan, or you can have a check sent directly to you. But if you do, you only have 60 days to deposit that check into the other IRA or retirement plan. If you miss the deadline, you may have to pay tax on the distribution, and you may have to pay an additional 10% tax on early distributions. However, if you miss the 60-day deadline because of circumstances beyond your control, such as an error made by a financial institution, you could be eligible for a waiver. You can even use our model letter on irs.gov to self-certify that you're eligible for a waiver. For more information on rolling over an IRA or retirement plan, go to irs.gov/rollovers. And for information about waivers, scroll down to FAQs relating to waivers of the 60-day rollover requirement.
That's some great information. You know, people are changing jobs all the time, and they need to know this. Well, Jim, what's the best vehicle to move your retirement funds to?
Well, it depends on the individual. Everyone has a unique situation, so there is no cookie cutter approach. We need to look at your goals, your objectives, how much income you desire or you'll need to maintain the lifestyle when you retire. So basically, the 401k plan, as the term goes, is really not a plan. It's a retirement savings vehicle. Okay. Now, what we need to do from that point is then sit down, take that vehicle, and incorporate that into a plan, because there are a number of things that need to be considered. One is that you need to make sure you can qualify for your benefits as you get older. You want to make sure you don't get your Social Security taxed. You want to be able to get qualified for Medicare when you need it. You want to address the issues of health care, long-term health care needs, and you want to have a source of income that will last you a lifetime. I mean, the worst thing to do is run out of money when you're in retirement. And then you also need to address the issue of legacy transfer, to transfer wealth to the next generation, to your children, your wife, and you want to do that in a tax-efficient manner.
And finally, Jim, what else do people need to be concerned about when planning for retirement?
When it comes to planning for retirement, the things that I mentioned earlier are the most important, because one thing that people fail to realize is that there have been a number of changes in the law. So you want to watch, we need to have a plan in place so that you can maximize the benefits when you retire. And basically in that particular situation, what we're talking about is an asset protection plan. There really needs to be a plan in place, and that would be an asset protection plan. Everything goes inside that plan, so that when you get ready to qualify, when you need Medicaid, you can qualify for 100% of your Medicaid. And we can structure the investments inside that plan so that we can minimize the taxable investments, maximize the tax-free income, so that you will be able to live the lifestyle and the desired retirement that you want.
Wow. Great information this morning, Jim. I know a lot of people are concerned about, rolling over their 401k. Just tell everybody how they can find you there, Jim.
Well, you can get in contact with us at griffithfinancialservices.com. That's our website. You can also contact us at 800-361-6542. And we're located at 907 Morningside Street, Suite D3 in Jackson.
All right. Do you like scary movies, Jim?
I do, Rob.
You do?
I do.
Well, coming up on the show, we're going to show you a preview of a scary movie called Happy Death Day. Is that it? Happy Death Day? So that'll be coming up in a few minutes, Jim.
That ranks right up there with my favorite, The Walking Dead, Rob.
Well, thank you so much, Jim. I appreciate it.
Thank you, Rob.
We'll see you back next week.
All right.
We're back after this.